Many investors focus heavily on choosing the right stocks, funds, or assets, but often overlook how taxes silently erode their profits. Taxation can take a surprising bite out of your investment gains, sometimes even more than fees or inflation, especially if you're unaware of how and when taxes apply. While some tax effects are obvious, like capital gains tax, others are hidden in the way accounts are structured, how dividends are taxed, or even how frequently you trade. Knowing how taxes affect your returns can mean the difference between merely decent performance and optimal long-term wealth building. In this video, we'll uncover 10 little-known ways taxes can reduce your investment returns, and how you can avoid or minimize them. 1. High turnover funds trigger short-term capital gains. Mutual funds or ETFs with high turnover rates frequently buy and sell stocks, often leading to short-term capital gains. These gains are taxed at your ordinary income rate, much higher than long-term capital gains rates. If you hold these funds in a taxable brokerage account, you may owe taxes on gains you never directly realized. Even worse, you pay those taxes annually, reducing your compounding potential over time. 2. Dividend income isn't always qualified. Not all dividends are taxed equally. While qualified dividends benefit from lower tax rates, non-qualified dividends, often from REITs, certain foreign stocks, or bond funds, are taxed at your regular income rate. Investors unaware of this distinction may see a large chunk of their income taxed more harshly than expected, especially in higher income brackets. 3. Taxable bond interest is ordinary income. Income from most corporate or government bonds, excluding municipals, is taxed as ordinary income. If you're in a high tax bracket, your bond interest could be significantly reduced by taxes. Unlike capital gains, there's no preferential rate for bond income, making fixed income investments less attractive on an after-tax basis unless held in tax-advantaged accounts. 4. Mutual fund distributions can blindside you. Mutual funds often distribute capital gains to shareholders at the end of the year, even if you just bought into the fund days before the distribution. This means you can owe taxes on gains you never benefited from. These phantom gains can be a frustrating and costly surprise to investors who don't time their fund purchases carefully. 5. Frequent trading increases tax drag. Active trading, especially in taxable accounts, can incur frequent tax events. Every sale that results in a gain is potentially taxable. Unlike long-term investing, where gains may be deferred or taxed at a lower rate, active traders often face a steady stream of tax liabilities, reducing net returns over time due to lost compounding. 6. Rebalancing can trigger taxes. Portfolio rebalancing helps maintain a target asset allocation, but when done in taxable accounts, it may involve selling appreciated assets and triggering capital gains taxes. Even small adjustments can add up over time. Unless rebalancing is done within tax-advantaged accounts, it can create an unseen drain on investment growth. 7. Taxation on foreign investment income. Investing in foreign securities or international funds can come with foreign withholding taxes on dividends, which may or may not be recoverable depending on the country and your account type. While you might receive a foreign tax credit, it's not always dollar for dollar, and you could end up with lower after-tax income than anticipated. 8. Lack of tax loss harvesting. Many investors miss out on the opportunity to use tax loss harvesting, selling losing investments to offset taxable gains. If you don't harvest losses strategically, you may pay more taxes than necessary. Losses can also offset up to $3,000 in ordinary income per year and carry forward indefinitely if unused. Yet many investors leave this benefit on the table. 9. Using the wrong account types. Holding high-tax investments like bonds or REITs in taxable accounts instead of IRAs or 401ks leads to higher taxes. Conversely, holding tax-efficient stock index funds in tax-deferred accounts wastes their tax efficiency. Asset location. The practice of placing assets in the most tax-advantageous accounts is often overlooked, yet it's key to optimizing after-tax returns. 10. Unawareness of capital gains bumps in retirement. Selling appreciated assets in retirement might seem like a smart move, but doing so without a plan can push your taxable income into higher brackets. This can increase your Medicare premiums or even make your Social Security benefits taxable. Without careful tax planning, retirement withdrawals or capital gains realization can cause unintended tax consequences. Taxes are an invisible but powerful force that can chip away at even the best investment strategies. While returns, fees, and diversification often dominate investor attention, tax efficiency should be just as important. From avoiding short-term capital gains to utilizing the right accounts for the right investments, every decision has tax implications that affect your bottom line. Fortunately, with awareness and careful planning, you can minimize tax drag and ensure more of your money stays invested and compounding. Remember, it's not just about how much you earn, but how much you keep after taxes that determines your financial success.